Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to quickly update you on recent changes in my stocks portfolio in the last couple of months. In this channel I don't tell you what stocks to buy or sell because I don't know about your investment goals, your risk tolerance, and your financial situation, but I will tell you what I'm doing with my own money and I show you the process of evaluating different companies and my process of long-term investing. I will try to update you every month with full transparency and show you the exact performance of our portfolios over long term. The combined portfolio of our family, me and my wife, worth a little bit over $167,000 today. The dollar figure of my own portfolio at the moment is close to $127,000, almost $114,000 in Wealthsimple, and $13,000 in National Bank direct brokerage account. One thing to note here in my Wealthsimple account is that I sold a couple of shares back in December 2024 and withdrew around 30,000 Canadian dollar from my TFSA to pay for a family emergency, and that's why you see this drop in the portfolio value here. But since March 2025, I started to contribute this money back into my accounts and slowly build up these positions again. We finally have this 42,000 Wealthsimple portfolio, which has shown an impressive 297% return in just 3 years. Of course, most of this extraordinary return came from our investment in Meta. Our initial investment of only $5,000 in Meta grew to more than 4 times its original size to almost $21,000. As our wealth is combined, we manage all of our assets as a single combined portfolio, which I track them here in this Excel sheet. Basically, most of the positions we hold in our portfolio are in the green. Some of them are significantly in the green. For example, Meta, which is in green by 360%. Tencent Holdings, which I received a lot of critique for buying it last year, around $35 per share, is now our second best performing stock, which is up 81% in less than just 2 years. Aritzia and Amazon are up around 75%. Brookfield Corporation is up 55%. Google, MasterCard, and EQ Bank are up 45 to 50%. These are all major outperformers in the portfolio, especially considering that we pretty much started these investments around 3 years ago. And the only stock which is really down here is LVMH or Louis Vuitton Moet Hennessy, which is down 29%. And I believe this one is actually represent a great buying opportunity here. I will talk more about each position, but now let's look at the overall portfolio allocation. This is a nice graphical representation of the stocks that we hold in our combined portfolio. This is an overall concentrated portfolio with only 13 different companies. The largest holding in this portfolio are Meta and Brookfield Corporation at 17% and 16% weighting, followed by Google and EQ Bank with equal 13% weighting. Then we have Alimentation Couche-Tard with 11% weighting, Amazon with 7%. Then we have 3 roughly equal size positions of 5% in LVMH, Novo Nordisk, and MasterCard. We have 4% in Aritzia, 3% in Tencent Holdings, and just 1% in Intact Financial. Top 6 positions in the portfolio form almost 75% of the value of our stocks portfolio at the moment, which shows how much I believe in these companies and how much we're concentrated in these positions. If the share price is right, the plan is to build a larger stake at the smaller stocks so we have a much more balanced portfolio at the end. In terms of the sector allocation, tech and financials are still our largest holdings, followed by consumer staples, consumer discretionary, and healthcare stocks. In terms of geographical allocation, most of our assets are in Canadian and US companies. A smaller portion of our assets are in European companies, and a tiny portion is invested in China. In terms of the dividends, the portfolio now pay me close to $1,000 per year in dividend. Not much compared to before, as I sold most of my dividend payer stocks like TD Bank and Granite REIT, but still $1,000 is decent considering these stocks are fast dividend growers. For example, EQ Bank, Alimentation Couche-Tard, Intact Financial, MasterCard, these are all companies that I expect significant increase in the dividends I will receive from these stocks in the future years. Now, let's go over each position in our portfolios and discuss the new changes. In terms of the individual account performance, let's look at my personal RRSP account first. My Wealthsimple RRSP consists of only stocks that are traded on US stock exchange, and it is up almost 70% so far in the last 3 years. I pretty much hold the same stocks here. I still have Amazon, Google, and MasterCard. But as you can see, I traded Monster Beverage for Novo Nordisk. That was the only change I had in this portfolio. Monster Beverage had a very nice run-up and the valuation was a little bit rich for my taste. And at the same time, I saw a great opportunity with Novo Nordisk, which in my opinion has a much better upside potential here at this price point. So I sold my Monster shares and bought into Novo Nordisk. I talked about Novo Nordisk in another video recently, but in a nutshell, I think Novo Nordisk is undervalued and it represents a great buying opportunity here. Right now I have 75 shares of Novo Nordisk and it is up 70% so far. I hope the stock price actually goes down again so I can buy more shares, but if Novo Nordisk continues to climb back up, I will be happily just hold my shares here. Additionally, I also have 36 shares of Amazon here, which is up 68% so far. Amazon by far was my best performing stock in this portfolio, and I started to add the stock in January 2023, which was probably one of the best times to buy Amazon. I wish I bought more shares during that time, but it is what it is. I bought almost 10 more shares of Amazon recently when the stock traded close to $170. And I like to add more Amazon if the price comes a little bit lower. I think Amazon here is probably fairly valued. It's not super attractive to me, but if the share price goes lower than that to something like $170, I will definitely buy more shares. I also have 85 shares of Google here, which I'm currently up 52% on the position. I believe the company is slightly undervalued here. I actually decided to trade a couple of MasterCard positions for Google when Google was down to $150 a couple of weeks ago, as I saw much better upside potential with Google at that price point. I might decide to add to my Google position in the coming weeks if the share price drops again, but I'm not in a rush here. If it goes down to $150, I will probably add more shares, but here I try to be patient with the stock, even though it is slightly undervalued. Next, I have 10 shares of MasterCard, and it is up 47%. To be honest, I think MasterCard is a little bit overvalued here. MasterCard is an amazing business, one of the best businesses in the world with excellent business model, margins, and growth trajectory. But I think right now it is a little bit overvalued. So I don't have any plan to add to MasterCard here. I really like the business, so I'm not going to sell all of my shares. But valuation of some of the US stocks like MasterCard are ridiculous right now. US market is truly overvalued at this point. So as you can see, my focus is not on buying US based companies at the moment. Outside of Wealthsimple, a national bank direct brokerage account in the RRSP, I continue to buy more shares of Louis Vuitton, LVMH stock. I own 55 shares of the company right now. I'm down almost 29% on this position so far. I have planned to buy more shares of LVMUY in the coming weeks as this luxury brand stock is extremely undervalued in my opinion. It is one of the best opportunities for me to increase my number of shares in this company. I also have 60 shares of Tencent holdings here, which is up 81% so far. I really wanted to increase my Tencent position, but the share price basically went exponentially up quickly after I bought the stock, and I'm still waiting for another dip to buy more shares of Tencent. I think Tencent here is fairly valued on the paper at least. It is on the paper it is undervalued, even here, which is much higher than, for example, last year. But considering the geopolitical risk of owning a Chinese business, I would say Tencent is probably fairly valued, considering the geopolitical risk. The opportunity to buy more shares of Tencent at attractive price may never come again, but in that case, I will just hold my shares and assess the situation again. Okay. Now, let's look at my personal TFSA account. This portfolio only consists of Canadian stocks. Its value is close to $67,000 today, and it is up 46% overall. It is a little bit underperforming my other portfolios, but considering it only consists of Canadian companies, it is widely outperformed Canadian market indices in the last 3 years. Here I had significant changes. I sold a couple of stocks here. I sold my Killam REIT, Granite REIT, Aritzia, and TD Bank. The main reason for selling out of these stocks was that I had to withdraw almost $35,000 in December for a family emergency, as I mentioned before. I didn't want to sell Brookfield Corporation or EQ Bank, as those two were my highest conviction stocks. So I sold the stocks that were underperforming, like REITs, the stocks that were in a major down cycle, like TD Bank, or they were simply overvalued in my opinion, like Aritzia. So I used this opportunity to shift the focus of the portfolio to more growth-oriented businesses with wide moats. In particular, Aritzia was up something like 60% for me at the time, so I sold my stocks over there for a profit. We still own 100 shares of Aritzia in the other family portfolio that we own together, but as you can see here, I consolidated my holdings into only 3 stocks: Alimentation Couche-Tard, Brookfield Corporation, and EQ Bank, and I recently started to buy a new Canadian business here, which is Intact Financial. Okay, let's start with Alimentation Couche-Tard. In the last 6 months, I bought 160 extra shares of Couche-Tard, and now I own 250 shares of the company, which is actually flat right now. The stock had a pullback due to their plan to buy 7 & I, the holding company of 7-Eleven Japan, in a $38 billion deal. I mentioned in the other video that's why I believe the deal is probably not going through, and even if it goes through, I still see that as a positive for the stock in the long term. I don't think Couche-Tard share price will move dramatically to the upside or downside before we can see the fate of this huge deal. If the deal does not go through, I think Couche-Tard share price will immediately goes by at least 10% to the upside. And if the deal goes through, we probably see more downside move for the share price. Anyway, the deal is in the negotiation phase, so the stock price may not move much during this time. I'm happy with my position size in Couche-Tard and will hold my shares for now. Next, I have 330 shares of Brookfield Corporation. I am up 55% on the position so far. They recently had an excellent earnings report, and their businesses and their cash flow continue to grow fast. I believe even here close to its all-time high, Brookfield Corporation is slightly undervalued, and it is still a good place to invest money. I recently bought 50 more shares of Brookfield Corporation and averaged up on the stock, as I can see value in the business even here. I will probably pick up more shares here and there, especially if we see another drop in the share price. Next, I have 235 shares of EQ Bank, which is up close to 43% now. I bought 35 more shares of EQ Bank during the recent meltdown of the share price, and I'm totally happy with my weighting and position size in this great company. I believe this company can still grow and outperform other major banks in Canada and even major indices in the coming years. My plan with EQ Bank inside my TFSA is to hold the stock and enjoy the growing dividend of the company. At this price, I still tempted to buy more shares, but probably I will just hold my shares here. The last stock that I own here, which is a new addition to the portfolio, is Intact Financial. I talked about Intact Financial in the previous videos about the valuation of the stock. I recently started to buy this stock, and I only have a starter position with only 4 shares for now. Intact Financial is Canada's largest provider of property and casualty insurance. This is an excellent business with amazing track record and performance in the last couple of years. I believe the stock here is fairly valued, and I am waiting for a dip in the share price to buy more shares and build my position in the company. There you are, guys. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar videos. I will come back with a few more stock analysis videos soon, but until that time, I see you guys in the next video. Farewell.